I welcome you again to another video by reitspro.com, where we give you insights on REITs and InvITs in India. And if you are a little unfamiliar about REITs, reitspro.com is one site you can visit, and you can pause here and see all that is briefly about REITs and InvITs in India. Visit our site to know more. So I'm Gaurav Jain, and I am an author and trainer, and these are two books which you can search for on our site as well as on Amazon, and you can get a hold of these books to understand more about real estate and REITs and InvITs in India. So the topic today is real estate is up but REITs are down. Now we all know that real estate has been booming in the past few months in India, and we need to probably explore why there has been no property price correlation as far as REITs are concerned. And secondly, if you are a REIT investor, then are you stuck forever at current prices? These are the two issues we'll address in this video. So if you see the price trends, for example, this is a price trend for Bangalore, part of Bangalore. There has been 36 or 40% increase in Bangalore, and this has been a kind of price trend in Hyderabad also. So overall property prices have increased, including residential and commercial everywhere. So why not in REITs? In REITs, in fact, if you see the charts, have taken the maximum holding period, though the IPO times were different. Embassy 2019, Mindspace 2020, and Brookfield 2021. But if you see the charts, they are very, very different from what the actual scenario in properties holds in India. REIT properties, they are not standalone assets, and they are an aggregate of several properties. So this is the first point that one has to probably understand. So if you see there are something like 45 million square feet in Embassy with several occupiers, and what this means is that this is an aggregate of many renters, and REITs denote a use case for renters, and there is no emotional need fulfillment for investors. So because of this setup of the REIT, it becomes an investment tool. Say for example, residential, you could have sentiments, or some commercial shop, you could have sentiments. In pure commercial REITs like we have mostly in India, the three REITs that we have, and the fourth is a Nexus Select. So the result is that the REIT is an investment tool. What this means is that it is going to keep behaving like an investment tool in the long run. So what happens is that you are generally comparing investment products as a percentage, as yield products here. So this is a snapshot of what the Embassy, Mindspace, and Brookfield yields are today. And this relationship between REITs and real estate rent is now to be explored further. So obviously the REIT unit, you are getting a aggregate of property 1, property 3, where rents are flowing in these properties, and the REIT unit gives out a distribution which is dependent on the aggregate of these three property rentals. Having established this, the cash flows over a period of time for a REIT unit would be denoted as DPU over years. So the cash flows would be a sum of the dividends or the distributions that the REIT gives out over years. Similarly, the rental from properties is what the cash flows are generated over years. So both these terms are to be evaluated in terms of the cash flows over a period of time. Now, if you see the valuation reports, these are the kind of valuation methods that are mentioned here, and the valuation method mostly used is the discounted cash flow method. Which means, what does a DCF mean? People who are familiar with this would know that it's the value today of the various cash flows over a period of time. So the value today, if the cash flows are discounted, this is what the value of any property would be, and this would be the value of, say, a investment instrument also. In our case, the value of a REIT would be the cash flows that the REIT unit generates over a period of time. And similarly for the properties, it will be the value of the rentals that the property will generate over a period of time. Now this leads us to 2-3 conclusions. That the rent is the main source of income for REITs, first part. Number 2, the rent reflects in the DPU of the REIT. Thirdly, rents make DPUs range bound. Now, why this happens is what we are going to explore further. So the important part is that the rents determine the property value and vice versa. So this relationship between rents and prices, we would have all experienced at our own levels. So what you would have already seen is that if the prices in a certain locality increase, the rents demanded keep getting more. So the landlords want more rent for the same property. When the value appreciates, rent appreciate. Now how does this relationship in REITs happen? Now, unlike say agreements of 11 months or short-term agreements or in the unorganized sector, the REITs are constrained by agreements. Both the tenant and the landlord are constrained by agreements where there are lock-in periods and there are fixed interval agreements. So this gives us only limited increase over a period of time. So generally, if say there is a 9-year lease with a 3+3+3 clause, that's the kind of clauses that are there, that is the kind of agreement, both the landlord and the tenant have a faith in that and they would abide by it, unlike say an unorganized property market or a short-term market. So this means there would be a lag in the relationship taking effect. So this effect of rent and prices does not happen immediately. So what happens? What about the property values? Can't REIT just sell them off? That's what we would say next, right? So what if the value of the property has increased so much? Let the REIT just sell it off and make money out of it and give it to the shareholders or the REIT holders, right? So then it should increase, the price of the REIT value should increase. But what happens for a new buyer is that he or she also discounts what is the future of all the incomes, what is the present value of all the income. So the same chart that we have here, for a new buyer, the terminal value will again be all these cash flows. So whatever the amount that is locked in as a rental would be the ballpark point for a new buyer to evaluate or value a REIT, which means that we come to the second point. Are we forever stuck at low prices and low rents in case of REITs? Can REITs never realize the true asset value? That would be the natural second question which we would try to address here. We'll just have to go back a little bit back in our history of REITs. So if you see the COVID times, how were the rentals? So the cash flows were great in spite of the fact that there were empty offices and everybody thought there'll be permanent work from home and interest rates were something like 5% and you were getting about 7% or so on REITs. In fact, if you look at this, these snapshots, there was a 21.5 rupees payout of distribution in year 2021, most hit by COVID. Similarly, in 21-22 itself, these were the summation of all these gave you an upward of 21 rupees for the Embassy REIT cash flows. So these, why did it happen that there were empty offices and the outlook was bad and the interest rates were low and you were still getting? Because there is a certain time lag when it comes to REITs for all the alignments and readjustments. So the realigned rentals can happen when there is a vacation of office spaces, the offices are vacated, and there is renegotiation as per market rates at the end of the lease. So market trends are to be assessed as price related and then they are negotiated by both the parties. Then that's where the market trends kick in. So there is a time for the contract to end. As one would know that rentals are on 3+3+3 year basis usually, or something like that, which I will share a screenshot, I'll share a little later. So are we saying that the rentals are the only basis in case of REITs? Well, REITs are a combination of real estate and a stock exchange listing. That's what makes a REIT. So obviously it has to get impacted by the stock market sentiments. If you see all these three charts we shared earlier, there have been major fluctuations in REITs prices. Now these fluctuations can be individual or macro related, non-specific to the REIT also. So the other reasons for price movements could be sentiments. So Brookfield Global Fund is getting impacted and therefore the Brookfield REIT may be impacted here. Then interest rate There could be an inverse relationship in the short run. Long run, there are different scenarios that can pan out. Legal issues, for example, how much a particular REIT has, say, an SEZ, or tax issues with individuals or budgetary changes. All these reasons can impact price movements. So if you like the video, please subscribe to us, and there is a WhatsApp discussion group if you wish to discuss more about REIT and InvITs with like-minded investors. You can visit our site, and the WhatsApp group link is also in the description. You can pause in these next two slides and see how rentals are used for valuation of REIT properties, and this also, and how the how stepwise evaluation exercise is taken, and how rents are generally fixed for properties, lock-in and expiry and so on. You can see here. Thank you so much. Do write to us, and we will be happy to get back to you. Thank you.